that we get the best possible quality of sound to make the most of it and make it available for folks down the line to have access to it when they want to have access to it. So that said, we're going to start with something a little bit different right now, and let you take a look at a commercial that we've got for a new initiative. All right, if you want to get more information, you can view that commercial again on our website, which is whyame.com. I think you'll find the contest certainly will be worth your time and energy. Get out of YouTube here, and I'm going to go ahead and hand the controls off to Dave. He's going to take over here and take us the rest of the way. This is Dave Bolito. He is the director of our asset-based products division, and he's going to spend some time with you here today, run you through our portfolio and why it's as important as it is. So take it away, Dave.
Hey, thanks, Mike, and thanks everybody for coming on the phone call today. The webinar looks like we've got quite a few people out there, so there's been a lot of interest in this. Today's overview, and it's going to be a 10,000-foot level, a little bit about what you can be doing, what are we doing here at AIM, what's out there in the market space, and really why it makes sense today. It's a really timely solution to low interest rates, and it gives you an opportunity to show your clients something a little different. The overview, if we look at the screens, we're going to talk a little bit about the history. We're going to go into why this is so timely, a response to what's happening in the market space out there right now and why this makes sense. We'll cover really pretty briefly, but we'll give you an overview of the types of solutions out there, going from 20 years ago when there was one to today where there's 15. I've been asked to go through the carriers and where their niches are, and we'll cover that as well. And then also look at where the opportunities are. What are the primary ways that we fund these solutions? We'll cover the unique market opportunities that are out there, sort of the one-off spots that we're starting to see some people focus on. And then we'll cover our models, our compensation models, and how we can help you. So a little bit on the history of asset-based and linked benefit products. A little bit on the history of asset-based and linked benefit products. First, let's talk about that. The name for this, linked benefit products, asset-based solutions, hybrid long-term care, they all effectively are nomenclature for the same thing. It all started about 25 years ago with Lincoln's MoneyGuard. A lot of you have sold against MoneyGuard over the years, and it is, and it's the old guard in our industry and my niche that I work in, and it is still today a major player in the industry. It's been 20 years in the making, but now we have 15 products / companies out there, and I'd say every quarter we're seeing a new company come on board. Really, if you go back to the 90s and we look at this and the history of long-term care, really that was the onset of the return of premium model, where they were trying to find solutions that would market long-term care into different areas other than just health agent sales. And the return of premium model was directed really it was focused on our financial advisors, our CPAs, et cetera. But then they came up with really focusing on using an asset-based solution, a lump sum solution. And they took it one step further and was able to offer different caveats that offered opportunities for you to sell something that maybe you didn't have to argue the use it or lose it mentality anymore. So that's a little bit on the history. They've been around for 25 years. I think clients still perceive this to be something new, something they haven't seen before. Not a lot of showing of it yet, but still it's one of the fastest growing areas, if not the fastest growing market in the health area. Why now? So 20 years ago, we were in a different interest rate environment. We were in a different underwriting environment. So, why this makes sense now more than it did then is it's really a response to a challenging underwriting environment, an environment that actually has pushed some of our long-term care agents out to the margins where they don't really even focus on long-term care anymore. But now we have a tool here that challenges that difficult underwriting model because of X, and we'll get into what that X is a little later in the webinar. We also are able to work with adverse selection. It's one step off of the difficult underwriting process. By difficult underwriting process, I think sometimes we're talking about time and then time to a decline. Adverse selection is we can actually put some clients into these products that maybe they would not even be approved or we would not normally look at from a traditional long-term care model. It also, with so much of the premium increases out there, if we think about the psychology of the agent and then also the end customer, these premium increases have left a bad taste in our mouths on how do we proceed with long-term care. We don't want surprises. Well, some of these products are fully guaranteed whole life models. Some of them are annuity models. We can show them on both the guaranteed and the non-guaranteed side, and they work on both sides of the ledger. In fact, in most cases today, the guaranteed and the non-guaranteed are the same. Also, it's a way to attract a self-insurer, that client that the Wall Street Journal says only needs $1.5 million to support themselves. So that was predicated on a 5% riskless investment world. And we are so far from that today that 1.5 million is probably not the client that's purely the self-insurer. It's somebody that can self-insure, but they should be looking at long-term care one way or the other. But even in that high net worth space, that middle mass affluent to high net worth space, these really make sense. And we're able to argue against that use it or lose it mentality and that excuse. So the types of solutions that are out there. I call it package life and LTC. It's a one-stop shop. You push the button, you put the funds into it, and they have both life and long-term care. That life benefit is accelerated to the client upon need for care. There are also annuity-based solutions out there. And the annuity-based solutions offer really friendly underwriting process because if a client's putting $100,000 into it and we're leveraging it up from $100,000 to $300,000, that client's really spending, unlike on the life side where it's coming out of the death benefit and the company's on the hook, period, for those funds. On the annuity chassis, we get the leverage for that self-insured client, but they're going to spend down their $100,000 first before they go into the company's funds, which is the back end $200,000 or $150,000 that's behind that $100,000. And then there's life with ULs or universal life or index universal life policies that have long-term care riders or agreements. It's typically a life sale, and when we add this as a way to solve we solve two birds for one stone. It's a little bit removed from the packaged model. It's also an opportunity for those of you that like continuous pay and ongoing premium modes. There's opportunity there that we can show a solution that still has a benefit if they never use it. And then out in the margin, there's some really creative products out there right now that represent a small portion of this growth, but they're interesting. So there are enhanced annuitization products, meaning that if a client goes on claim, it's an annuity, but if a client goes on claim, they can push the button on the annuitization schedule and they will get a significant amount over traditional annuitization rates. And we even have one of those that's a guaranteed issue product. We also have very uniquely a reverse underwriting product. So if we have a client that's actually already on claim and they want to fund their claim, there's a company out there that will look at that and say, we think their life expectancy is this, and we will pay them an annuitization amount for that period of time. If that client outlives that period of time, they continue to make that payment on it. It's a unique product. It's something that maybe you keep in your back pocket and use as a discussion point, but it also opens up the opportunity for to talk about the more traditional pieces. And a little bit on these solutions, what we're seeing right now, LIMRA study, about 30% of all premium is based for long-term care is based in these products, and it's growing faster and faster, larger and larger, especially over the last 5 years. And I'll get into why it's really over the last 5 years. So here's an overview of some of the carriers that are out there in the market space. There's more, but I think this covers a good bit of ground. Each one, I get asked all the time, what is the best policy out there for my client? And it really depends. It depends on your client's health, your client's psychology. How willing are they to go through a full underwriting process versus a simplified underwriting process? And really your psychology as well. Or do we want max LTC benefit, but we're willing to take that client on a 2 to 3 month process to get them the approval? Or do we want something that, for a self-insurer that hasn't done this yet, do we want to solve for most of the problems or all the problems but use a more simplified package? So looking at these carriers, just to do an overview, Genworth and Lincoln. Lincoln, I said they've been around a long time. It's a package product. Genworth and Lincoln both have really a very strong LTC pool. Upwards of 6 times the original investment can be used for long-term care. So an incredible leverage point. Death benefit pretty reduced versus what you would get from a traditional life insurance contract, but really it solves for long-term care significantly. The downside to it is extended and protracted underwriting with full mortality, full morbidity, full paramed, blood, urine, etc. Pretty similar to what you would get from the traditional underwriting process. That being said, Lincoln seems to be making a move towards the center when it comes to ease of underwriting and trying to separate themselves from Genworth or Pac Life with the full underwriting process. But we're still a little ways from them being, I would call, simplified. One America, State Life Insurance of Indiana, they've been doing this for about 15 years. They offer a couple unique products. One, they offer the ability to do it joint. They're the only carrier out there that allows for joint, and it gives us the opportunity, if one of our clients, the chassis is second to die, if one of our clients end up being health challenged, because it's a second to die policy, we get some latitude on that one life. And so it works really well with the married couple. They also have the ability to use qualified funds. And the qualified funds does not mean we can hold life insurance in that IRA, but we can systematically drip out over 20 years in a tax-efficient manner the amount of money needed to fund the life insurance policy that buys immediately the long-term care benefit. And that would be difficult if we had to do that on our own, because we'd have to go back to the client each and every year. But they have a push-button package that allows that to take place. Very streamlined, easier underwriting than you find in the field. Some of these policies are approved within 24 hours. There is typically an MIB and a script hit. There's no paramed exam. There's a cognitive. And one of their other advantages is they're really the only carrier out there that has a competitive annuity and a competitive package life product. So if we apply on the package life side, we're able to get a secondary offer. If we're declined on the life side, we are oftentimes able to get a secondary offer on the annuity side. Nationwide, great story for larger dollars, referrals from CPAs. I find that CPAs are really hung up on indemnity. There was probably in one of the trade journals or consistently in trade journals a story about indemnity-based plans. So they often ask about it. And my explanation is indemnity doesn't really matter unless the amount that we're talking about is above the cost of care. But they like the indemnity model where the checks come and there's not much work on our end to get them to get those checks coming. They offer both a traditional life UL, IUL plan with a rider, and they also offered a package product, and that package product is indemnity. And if you have a larger dollar client, it's a really interesting story, or a referral from CPAs, or if you work with centers of influence, sometimes it's nice to start with this product as something to show those. Forethought is, many of you know Forethought on their annuities. Well, they also have a long-term care annuity, 3 times benefit. Just a really good story. Client puts $100,000 into it, and it's worth $300,000 for care. The value of the annuity never reverses. Gillico has the ability to do qualified money over 5 years. It's an annuity chassis. They have lots of options, and they also offer that guaranteed issue product that I spoke of earlier. And so that's a place out there for that, and it's something that you should look at for clients that have decent amount of money that maybe just can't get approved through these plans or through traditional LTC. Something we've come across in the last, I'd say in the last month or so, is Mutual of Omaha has a really unique product. It's a term that's convertible, and it's convertible with a chronic illness rider. So it can go to a permanent product with a chronic illness rider. So your client can buy this term policy, and if your client finds themselves in facility, they can convert this, and that chronic care, while they're in facility, and that chronic care rider is still available to them. It's a guaranteed convertible product. And it's a story we're just starting to look at. I find it really unique. I think it's kind of something, if there are folks out there that do a decent amount of life insurance, give me a call at the end of this. I'd love to talk to you a little bit more about this. Plays really well in that 45 to 60 range for the client that's buying term coverage, and it takes the pricing model out of term. It's not just shopped on cost. So where do we find money for these? I think the most compelling story out there is that we have low interest rates. We've got clients sitting on funds at 0.2%, and it's there as their emergency source of money. A lot of us tell that buckets of money story, where the first bucket is safe money, second bucket's medium term, and we do asset allocation within that second bucket, and the third bucket's also asset allocated, but more towards growth and future income. That first bucket's a difficult bucket to touch because that's usually held in banks, and it's emergency reserves. Now we can, because I can structure these policies if we need to have return of premium. And I have an example that I'm going to show you on that. So the client can always get that money back if they need it. Really, another place is qualified plans. I believe that's showing that one-stop shop with Gillico and with One America State Life. That's a fantastic story. Clients have to take money out of their plans anyway at age 70. So what we're going to show them, whether it's sooner than that or after that, is a place that gets them, if they never use it, a tax-free benefit, and the money's coming out taxable, but we're going to convert it to an income tax-free benefit. Life policies with cash value. Some of our business owners have large policies out there that have large cash accumulation there. They don't really need the life policy anymore. The kids are all grown up. They're out of college. They bought a UL with cash accumulation features, and now we can talk to them, what's the priority? If the priority is solving for the emergency, if we dissect what that emergency really is, that emergency is almost always a long-term care process. It's not, well, I think I'm going to need this to buy a boat. And they're probably past that point in their life. The emergency funds are really used for concern about care. Well, we can take that policy, possibly reduce the death benefit, but we're offering them a significant amount of care while still maintaining some level of death benefit for their heirs or legacy benefit. The biggest untapped market out there right now, and the most interesting story out there that's not being spoken about enough, is old annuities that have gains. Because of the Pension Protection Act of 2006, which really didn't come around and mean anything to us until 2010. There was a 4-year delay. Your clients can take an old annuity with gains, a $100,000 CREF annuity that's now worth $250,000, and they can put it into a PPA-compliant annuity. There's only 4 of them. And they can turn that gain into income tax-free funds to pay for qualified long-term care expenses. An interesting way to open up that conversation, some of you do business in annuities, some do not, but one thing you can always ask is, I would venture to guess that you do have annuities out there. I'm curious if you know if your annuity is PPA or Pension Protection Act compliant, because it offers you a grand advantage if you ever need it for care. Most of them, 99.99% of them are not, but it gives you the opportunity to review them and then show them an alternative. That is a story. If anybody also wants to talk about that, please contact me after this. I can go through the details of the PPA. It's a bit more of a technical sale, but it opens up a lot of doors and opportunities. So let's get to an example. This is a pretty simple example that we just recently did in the last 10 days, proved in less than 5 days. Actually, it was approved in less than 2 days. So it was a married couple. Joint policy, 57-year-old married couple. They were both 57. They put a $150,000 lump sum. Now, a little bit about the lump sum. Most of the business right now is being done in the lump sum, but what's really showing some signs of life are the continuous pay, 20 pay, 10 pay models. And so that's also out there if you have a client that's got large amount of income coming out of annuities or pensions, that we can fund it on an ongoing basis. But this is a pretty typical case. 57-year-old married couple, the funds were sitting in a bank account getting 0.2% or something to that effect. So they put $150,000 into it. There's 3 options. When I show this, I'll put $150,000 at the top. I'll draw 3 arrows. On one, I'll draw $7,707 for 50 months. So that client can pull $7,707 out for 50 months. Or the use it or lose it excuse is no longer there. If they never use this, that $150,000 passes on as $384,000 as a legacy life insurance death benefit to their heirs. So there's 2 options while they're living. $7,707 over 50 months, and then $384,000 if they never use it. The question that should come up, and most of the time does, is what if they use part of it? Very similar to an annuity. When you pull income out of annuity, there is a death benefit that's $384. If this client pulled $50,000 out of this account, it would be $384 minus $50,000 that would be passed on to their heirs upon death. So just because you start taking the income does not mean that you default on the rest of the death benefit. It's not annuitized. Lastly, so your client says, I don't know if I want to put $150,000 into this. A little typo on this on number 3. They don't get $250,000 out, but they can always pull the $150,000 out of this account. That's the worst case scenario on this investment, is if they put that money in today, they get that benefit of $384. That's $7,707. If they change their mind 2 days, 2 years, 20 years from now, it's guaranteed to be worth contractually in the policy, in the illustration, no less than the original investment going in. In this particular example, the $150,000 at the end of year 10 was worth $182,000 on the guaranteed side of the ledger, the worst case scenario. So why they're able to do this and why they're able to show a cancellation that's attractive to your client today is it's an insurance company that's concerned about risk. If we buy this contract today and 8 years from now you want to give it up when you may be in the sweet spot of where you may need care, these insurance companies are more than happy to send you back your original investment or your original investment plus some. So, and that's a good story. It gets clients the idea that, hey, this isn't that much different than that first bucket of money that I've got this money sitting at the bank account. Lastly, on that illustration, for $885 a year, we can make that $7,707, just the number 1 on this. We can make that lifetime for both parties in that married couple. So if they were both on claim at the same time, this company would be paying $15,400 a month out, and there's no risk to ever running out of funds. For $885 a year, we make this lifetime. So I think this was a pretty compelling story. It resonated with the client. He had thought about long-term care for a long time. He was He was more the mass affluent. He wasn't high net worth. And for him, it made quite a bit of sense, and for him and his wife. So unique marketing opportunities, niches that are out there, places to focus on if they're in your market or if they're in your books of business. IRA funds, clients that say, well, most of my money's in an IRA. We can take care of it. We can solve for care using some of those funds from the IRA. On that joint policy that we showed before, we can write these up to age 80. So if we need to, if a client's 78 years old, if the child is less than 25 years his minor, we can add the child to the policy. So 75-year-old and a 55-year-old son, we can put them on the same policy and can be joined. The issue here, and we'll deal with the next subject as well, is insurable interest. So that average age shrinks. We take care of mom or dad, and then at the point of their demise, they can choose to keep the policy, cancel the policy, or rewrite the policy under them because they might have a higher benefit. Another place that's really we're showing some growth is same-sex partnerships. Insurable interest is key, and same-sex partnerships qualify for insurable interest, and we can put two parties on this. Same ideas we can do with business owners as well. It's another opportunity where we see where we can put joint on this as well. The mass affluent, high mass affluent, and high net worth. I regularly meet with estate planning attorneys. I'd say half a dozen a month. And one of the things we get to when we have those conversations is initially we recognize that most of the time their clients, unless they're special needs trust situations, most of the time their clients can afford to self-insure. And I listen to it and I listen to it, and I'm going to say, well, I'm going to show you a reason why they don't have to anymore. And so for a client like that, an example of this is about a year and a half ago, a very high net worth client and a very, very astute estate planning attorney, their client eventually ended up putting $500,000 into one of these policies for him and his wife. It got them $1 million in benefit. They could still get their $500,000 out. And then if they ever didn't use this and they died, $1 million transferred to their heirs. No big deal. They had a large, large life policy behind it, but it just made sense. They did not have to self-insure anymore, and they leveraged $500,000 by another $500,000 for care. And that estate planning attorney came to terms with it this way. He goes, I'm not saying my client needs this. He said this to his client. I'm not saying you need to buy this. I just don't say why you wouldn't. And what we're seeing is these policies, the self-insured market, when we dissect that self-insured market, it's typically the mass affluent and the high net worth, and they no longer have to self-insure. We can show them a viable option, and it's a great story to go into your centers of influence and start discussing because they are not that familiar with it as well. So we're coming to the end. Compensation. We have two compensation models here in our department. We have typical, traditional, street-level compensation that pays on these products to you. We also offer a concierge-level service, and that is we'll do a split with you. I will take your client from point A to point B, and you will get feedback from me on what happened, and then prior to doing it, I will run it by you, make sure that we're on the same page, and we just do. I take it out of your hands. You're welcome to be a part of it, and oftentimes what we see is people start with 1, 2, or 3 cases on the concierge level model, and then say, I'm pretty comfortable with this now. I want to give it a go on my own. And I'm comfortable with either of these two. My goal is to help you produce. So I'm here. I'm willing to help. There's my phone number, and I think at this point we're going to open it up to some questions if anybody has any questions out there.
Yes, we are going to open it up for questions. I'd ask. Okay. I was going to ask people if they are not going to be participating in the Q&A after they've been unmuted, and everybody will be, to go ahead and hit *6 to unmute and or to mute yourself. I'm sorry, and you just heard there why we want to do that, so that if we've got active tertiary conversations going on, they're not interrupting. So
thanks, Mike.
We're open up for questions. Dave's here Fire away. If you don't, if you haven't hit the 2 or 3 digit PIN code to unmute yourself, go ahead and hit that, and I'll go through and get you. I'll catch up with you and get you ready to go. But let's take any questions that we've got for Dave on this really interesting and compelling opportunity with asset-based long-term care.
Are we going to get a copy of the slides?
If you'd like a copy of the slides, I'd be glad to make one available to you. Send me an email. Anybody that wants one, it's mike.anderson. We'll send you that. We'll send you the contracting material for a couple of our carriers so that we can get all that wrapped up at one time. Mike.anderson at WHYAIM, WHYAIM.com, and we'll take care of that. Any other questions out there? We do have one that somebody sent to us electronically. Dave, how are they going to handle or address inflation protection on these asset-based products?
So we can add inflation protection to it. There's a couple of ways we can do it. If the client has enough funds, I prefer to see them put more into it and inflate that monthly benefit above what the current cost of care is, because it gives us more options on the return of premium, gives us more options on maintaining the integrity of the investment. Beyond that, some of the companies also offer an inflation rider. Some of them will kick in immediately, but some of them also wait for the period of time that the initial claim is paid out, and then that benefit kicks in. So what happens is when you give me those options, depending on the client's age, I will draw up a couple different illustrations for you, and then we'll go through each one on the phone and see which one makes the most sense or is the path of least resistance for you to show to your client. But it's out there. You certainly can add inflation to these as a rider.
Okay, good answer. Thanks for the question. Anybody else out there with questions? You can send them electronically. Oh, they're coming in electronically. No, okay, that's not really a question. All right, anybody else out there have questions that they want to cover with Dave on this? Again, if you're looking for the slides, you can email me, mike.anderson at WHYAIM, WHYAIM.com. If you have questions on the contest for the fourth quarter with the TV giveaway that you saw the commercial for at the beginning, you can give any of us here at AIM a call at 800-672-7202. And if you have specific cases where you think asset-based would be a better play, Dave's here. There's the phone number. You can reach him here at AIM, and we'll do everything we can to help you out.
Mike, can I close with one thing?
Close.
I work on a couple different areas. I work behind the scenes doing case design. I also am out in the field. I will do conference calls with you and your clients. I will meet with some of your centers of influence if you feel comfortable bringing me in on those meetings. I'd love to just try to help you generate and start this space in your business model.
Outstanding. Okay, one more time for questions. Again, if you want a copy of the slides or you need anything else, you can email me at mike.anderson at WHYAIM, WHYAIM.com. We'll get the material over to you. Another question here. Which companies do not start inflation when the policy is purchased, but instead wait until the benefits commence?
Would you, if that person can just contact me directly, I'll go through that. That's a much more technical question. If we can just go ahead and if we can get that, let me give you my number. My cell phone number is 509-834-1100, and the answer really involves traditional UL, traditional IUL, and then also the package product. So if you don't mind just giving me a call on that number, I'll be happy to help you with that answer.
Yeah, the phone number's on the screen for you there, folks. Okay, any other questions? Okay, we will go ahead and wrap it up again. This will be archived. It will be available on the whyaim.com website later today under the news and events category if you want to circle back and watch any part of it again. All right, thanks, folks. Have a great day. We appreciate your time.